Welcome to The Explainer. Today, we're diving deep into a real heavyweight on the UAE stock market, ADNOC Distribution. And hey, if you're an investor on the hunt for solid dividend income, you're definitely going to want to stick around for this one.
So here's the billion dirham question, right? Could this actually be the UAE's best dividend stock? Well, that's exactly what we're here to figure out. Over the next few minutes, we're going to dig into the numbers, unpack the strategy, and look at the risks to see if it really stacks up.
All right, here's how we're going to break it down. First, we'll get to know the business. Then, we'll crunch the numbers on its valuation. After that, we'll look at all the good stuff, the upside, and then, of course, the potential risks. And finally, we'll pull it all together for the final verdict. Let's jump right in.
Okay, first things first. What is ADNOC Distribution? I mean, we all know the name, we see the stations everywhere, but trust me, the business goes way beyond just the gas pump.
Get this. Over 900. That's the number of service stations they run. It makes them, without a doubt, the biggest fuel retailer here in the UAE. And they're not just sitting still either. They're expanding, with a growing presence in places like Saudi Arabia and Egypt too.
But here's the thing, it's not just about fuel, not even close. Think about their ADNOC Oasis convenience stores, their car care services, and they're already making a big play in the future with a pretty serious EV charging network. Oh, and you can't forget the rewards program. It has 2.5 million users. So when you put all those pieces together, you realize, wow, this is a full-blown retail and mobility powerhouse. All right, let's talk about what every investor really wants to know. What's the price tag? Let's get into the valuation and see what the numbers are telling us. Just look at this revenue growth. The trend is crystal clear. It's pointing straight up. I mean, it's jumped from about 21 billion dirhams to almost 35 billion in just a couple of years. That's driven by more people on the road and, of course, them opening more and more stations. That is a seriously healthy sign for any business.
And all that growing revenue? Well, it translates into some pretty serious profit. We're talking 2.63 billion dirhams in net profit for 2023. That shows you this isn't just a big company. It's a company with some real stable earnings power.
So, what's really fascinating is how that profit connects to the stock's price, its valuation. To figure this out, investors use a tool called the price-to-earnings ratio, or PE ratio. Think of it like a price tag. A lower PE ratio can often mean you're getting a better deal on the stock.
And this is where it gets really interesting. Take a look at this comparison. ADNOC Distribution has a PE ratio of around 16 or 17. Now compare that to a peer like Solek, which is trading at over 30. That's a massive difference. What this suggests is that, compared to others in the market, ADNOC Distribution might just be on sale, trading at a pretty significant discount.
Okay, for all you income investors out there, this is the number you've been waiting for. 5.6%. That's the current dividend yield. It's like a direct cash reward paid right to you just for owning the stock. And let me tell you, in today's market, that is a very attractive number. So you add it all up. What kind of total return could you be looking at? Well, the analysis suggests something in the range of 8 to 12% a year. And that comes from two places. That really solid dividend we just talked about, plus the potential for the stock's price to go up over time. Not bad at all.
So, with those numbers in mind, let's build out the bull case. What are the big arguments for why this is a great investment? Let's dig into the core strengths.
See, the thing is, it's not just one single reason to be optimistic. It's a whole collection of them. First off, they absolutely dominate the UAE fuel market. They're also just a cash-generating machine. On top of that, they've got an aggressive growth plan to hit over 1,000 stations by 2028. And they're not just a one-trick pony. They're diversifying into non-fuel retail, which is growing fast. And of course, having the backing of ADNOC itself, well, that's a huge plus. They are clearly trying to build for the future.
But, of course, no investment is a sure thing. A smart investor always flips the coin over to look at the other side. So what are the risks here? What's the bear case?
Okay, the elephant in the room for any company that sells gasoline, right? The global shift to electric vehicles. It's a huge long-term risk. I mean, what does the future look like for a fuel company when the world is going electric?
Well, here's their answer to that. They aren't sticking their head in the sand. They're tackling this challenge head-on. Their plan is to build out a leading EV charging network, aiming for over 500 fast chargers by 2028. The goal is to be a key player in the future of driving, not just a leftover from the past.
The other big risk is pretty straightforward. Their main business is tied to fuel sales and oil prices. If the economy slows down or if oil prices suddenly spike, that can definitely put a squeeze on their profits. It's just the nature of the beast.
So what's their game plan to fight that? Well, it's pretty smart. They're diversifying by turning their service stations into real destinations. They're bringing in huge, popular brands like Starbucks and Al Bake. Think about it. That brings people in and generates profit that has absolutely nothing to do with the price of a barrel of oil. It makes the whole business a lot more stable. Okay, we've looked at the bull case, we've looked at the bear case, and we've seen how the company is trying to handle those risks. So let's tie it all together. What's the final verdict for someone thinking about investing?
When you boil it all down, this is what it looks like. In the pros column, you've got that dominant market position, a high and stable dividend, and what looks like a really attractive valuation. In the cons column, you have the big questions about the EV transition and their dependence on fuel. But the key thing to remember is that they're not just ignoring those risks. They have a clear plan to tackle them.
So, what's the bottom line? The analysis comes out with a clear buy rating on the stock. For an investor looking at a 2 to 3 year horizon, the mix of stable cash flow, that very visible dividend, and potential for growth, well, it makes for a pretty compelling story.
And that leaves us with one last big thought to chew on. Can a legacy energy giant like this truly transform itself to power the future? Their strategy says yes, but as with any great plan, the real test, well, that's going to be in the execution.